Alrighty, so hopefully you are pretty comfortable or starting to get familiar with the idea of sweep zones, right? Those POIs that sweep liquidity as they are created as a potential additional signal that BFIs, institutions were involved in the creation of that POI, right? So now we can dive into the juicy topic of inducement. Now, liquidity in general and the topic of inducement specifically, it's something kind of over the years it's been a bit of a blind spot in my own trading. I've been aware of it, I've used it to a loose degree, but I've never dived deep enough into it and taken it seriously enough because I hadn't done it. I don't know, I'm not going to give excuses as to why, but I feel like I never really had a kind of systematic way of approaching it, which is now what we've been doing a lot of work on that topic and getting it to that point where we can try and make it as mechanical as possible. And also the point I'm trying to make here is that as the years have gone on, the months have gone by, I've realized it's becoming more and more important to my trading, and it's super important to try and reduce taking unnecessary losses, really. And when you start to spot it and you get it and you kind of have this systematic framework in place that would allow you to know exactly what to do in each scenario, it's super useful. But before, this is where we can get now over the next few lessons. It might feel like we're getting a little bit lost in the sauce, so I'm going to keep just drilling home this idea, the overall philosophy of what we're trying to do. And I think if you really understand the why, or at least the theory behind the why, it can help you to really grasp these concepts that we're about to dive into, over the next few lessons, where it can get quite technical. But if you can hold on to this, the idea of what we're trying to do here with liquidity, I think it can really help you to get your head around it, or at least it helps me. So let's go through it again, right? Won't spend ages on this, but we know very oversimplified version of what an order book could look like, where essentially on the left, we have price levels, right? Which is essentially just these prices over here. We know at every single line in the market, there's going to be supply and demand, obviously, if it's liquid, okay? So essentially this is where, imagine the current prices. So if you look at your broker and you're looking at euro dollar, if you go on MT4 or whatever, it will have a bid and it will have an ask. This will be the current bid price, 1013. This will be the current ask price, okay? And if you want to buy, you have to buy at the ask. You have to cross the spread. You have to buy up here. Why? Well, because that's where the nearest seller is. And if you're buying, you need a seller, okay? So if you want to buy, that is the current market price you would have to buy at if you wanted to enter straight away, okay? And obviously the difference is a spread. You have a 1 pip spread. That's where you need to go. And if you wanted to sell at the current market price, you would have to sell down here, right? You buy off the bid. That's the current highest bidder. So if you're selling, you would sell it off the person looking to buy from you at that price, okay? So if you are a large market participant and you want to buy and you want to get long, and you want to get long at the current market price, so you're going to have to start buying at 1014, and let's say you want to buy $700,000 worth of whatever currency, okay? There's only 500,000 worth volume being sold at the nearest price level. So if you were to just hit a market order of market buy, you would instantly fill that up, okay? And then your broker is going to look for the remaining 200,000 left of your order, right? And what's it going to do? It's going to skip this level because there's no one there. It's going to skip this level because there's no one there. It's going to hit that and it's going to absorb that 100. So now you've got 600,000 filled. Quick maths, what you need another 100K, right? And it will come up to here and it will take 100K off that level. So now you've got the majority of your order filled here, but then you get some of it partially filled up here and here, okay? So you essentially get slippage, right? So if you're a big market participant, you want to reduce that as much as possible because you want to get filled at the best possible price, right? Ideally, there's at least 700,000 here for your order. So when you get in, you're in with your entire position here and not, some of it scattered all the way up here, right? So that's why we say for every buy order, it must have an equivalent sell order for a trade to take place, or not an equivalent order, but an equivalent amount of volume for you to get filled out, okay? So large market participants need an equally large opposing amount of supply or demand to enter and exit the market with minimal slippage, right? So hopefully I've really tried to drill that into you guys, and it will help you to now hold on to that idea that the big guys, they need as much liquidity as possible to enter, or at least that's the theory, right? It makes sense to me. So let's look at how we use this with our trading. Okay, so topic of inducement, there's a fair amount of words here. Okay, we'll dive into this in a minute. Of course, there's notes below the video, which you can read in your own time, but let's start with the sort of simple concept and we'll go from there, okay? So like I said over here, let's think about buying first. If you're a big guy and you want to buy, what do you need? You need a ton of people selling near the level in which you want to transact at. So if you need that sell side liquidity, okay, where on the price chart do we think there's going to be a lot of those sellers involved, right? And we kind of touched on this before. We want to look for where there's that sell side liquidity, which we know builds up below lows for different various reasons, okay? So in the market, if you have double bottoms building like this, what do we know people will be doing? They will be buying that support level or even the demand from within here, right? We know there'll be a lot of people getting long and having what? Having their stop losses behind the lows. So if you're long and you have a stop loss, what will that stop loss be? It will be a sell order because you'll need to sell back your position to the market if you're stopped out, okay? So when you see lows like that, sell side liquidity builds if people are getting long. Now you can have the exact same pattern, but another trader may view it in a different way. And they may go, well, if these lows break, they're significant lows, I want to short this, right? We think we're going to go, to zero or whatever. Or for some of you trade patterns, right? That's what people call a bear flag. And it's the exact same pattern as this, right? It's just equal lows, but that person wants to sell the break out of it. So even though this person's going long and this person's going short, what do? They both generate sell side liquidity because he's selling here and he's also selling here because he's selling back his long position, right? Another sort of example is where you would have a strong low, right? So a low that breaks the high, we could be looking to buy this. We could be looking to buy the demand that broke the high and, our stop losses are going to be behind that low. So what have we generated? We've generated more available sell side liquidity to the market, right? And what can happen is then we can get stopped out and then we get the movement, okay? So this is where people will often say like, my broker stop hunted me and all this stuff, manipulation, blah, 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 where you look like you just got stopped out and then it goes in your direction anyway. But what do we think is happening here? Well, like I said, if you're a big guy and you need to buy, you're going to be looking for where you think there's going to be a ton of sell side liquidity. And we know when there's obvious equal lows or, a strong low in the market, there's going to probably be a strong amount of sell side liquidity below that. And that's very often then where you'll see like a higher time frame POI, right? So imagine we've got some 4-hour demand. And if you're a big guy and you want to be buying, or we think the big guys are going to be buying from that demand level, and that's where we want to be getting long, what do they need to buy here? All right. Imagine this is like where we want to be getting long, where the institutions are potentially getting long, they're going to need this sell side liquidity, right? The money building below those lows, the people selling for the big guys to buy against, right? They need to buy against all of that sell volume so that they can get filled here and they don't, get filled here, here, and here, right? They want as much sell side liquidity, right, to buy into. They need people selling to them at this level, okay? So that's essentially the kind of bare bones idea of what we're trying to do here with the concept of inducement is we're looking for where has liquidity built in front of a POI, right? The opposing liquidity, so that can increase the probability that, if we're looking at, let me draw this, a POI, right? That broke structure. Okay, we want to see that liquidity be built in front of it because then the institutions can use that to get in potentially, right? And then the exact same opposite for buy side liquidity, right? Imagine, you want to be selling, or we think that this is a good POI. If we see that buy side liquidity build in front of it, right? People selling the double top, they've got their stop loss behind there, which will be a buy order, right? If you're short, you need to buy back your position, or people buying the breakout of the double top or the bull flag, whatever way they view it. Or again, if there's a strong high, people short the high, their stop loss, more buy side liquidity behind highs, right? So highs, we have the buy side liquidity behind it. And then if you've got a strong supply zone, right, like this, we think institutions are going to sell from here. They're going to need that buy side liquidity to sell into to reduce their slippage, okay? So when we say inducement, right, the Oxford English Dictionary, the Oxford English Dictionary definition, God, that was a mouthful, ironic, is of inducement is a thing that persuades or leads someone to do something, okay? So this pattern, right, these lows, the support level, whatever you want to call it, double bottom, whatever, it encourages market participants to think, okay, I want to buy here. I think this is a strong level. I think we're going to go up, and it induces them into the market to buy. It induces buyers, right? And that inducement by this pattern, this creation of these lows, it encourages them to get long. And what does that inducement create? It creates sell-side liquidity, okay? So in this instance, it's induced a buyer or buyers into the market to generate sell-side liquidity. Okay, same pattern over here. It doesn't induce a buyer in this instance, it induces a seller, but it still generates the same thing. It generates sell-side liquidity, okay? So equal lows or strong lows, lows in general, they induce buyers and sellers, but it generates sell-side liquidity, okay? For different reasons, but it all leads to the generation of sell-side liquidity below lows, right? So patterns in the market will induce, just encourage, right? Entice market participants, so traders, to transact at certain levels. All that means is it will encourage you to take a trade here that will generate that sell-side liquidity. That's all it basically means. Fancy words to say, if you see lows, sell-side liquidity is likely going to build behind it. If you see highs, it's likely buy-side liquidity is going to be building above those highs, right? And the more stronger the high, the more we can assume potentially there's more buy-side liquidity. Like when we get nice, big, obvious equal highs, or we get a strong high, right? We can assume there's going to be more buy-side liquidity behind it, okay? So what we say is those patterns that induce market participants generates available liquidity, so liquidity that hasn't been used yet. So this is fresh liquidity that a market participant, a BFI, can use to buy against for other market participants to use, right? So we look for the patterns to induce, to get you involved, to generate sell-side liquidity for BFIs to utilize, okay? So identifying inducement that generates that available liquidity in front of a POI that we're looking to get involved in, right? That can increase the probability of these POIs holding, right? It's just another signal that if you have a strong zone like this that led to a broker structure, or even one that maybe like swept liquidity, right, below that low, led to a breaker structure. If we then see inducement building here, it can increase the probability that, you know, they're going to use that liquidity to then fuel that movement, right? And that's what we're looking for, okay? And yeah, so available liquidity is those resting untapped orders. Obviously, this is when it's been tapped into, but before it's been tapped into when it's fresh, that's available liquidity. Inducement is essentially the pattern inducing market participants, buyers or sellers, but to generate that sell-side liquidity for other participants to use, right, to buy against. The liquidation is when the move actually happens, when price is tapped into that liquidity, these people are liquidated out of their positions, right? It's the liquidation, so market participants taken out of the market. And then sell-side liquidity, like I said, it's just the sell-side liquidity below the lows and then buy-side liquidity behind the highs. So super sort of, you know, let's again, not get too lost in the detail. Quick recap of what we've been doing. We looked at market structure, lower low, lower high, lower low, right? And we can see that that high broke the low. So we think that this is a strong high, right? Because it broke the low. So then what do? We look back and we go, okay, was there any supply in this level? And it's a strong or an institutional structure zone because it broke structure. Okay, happy days. Next level from that was then we looked at the concept of liquidity. Okay, and then what you may get is something like this, where this high breaks a low like that, right? And then we may get a pullback where price then sweeps the liquidity behind that strong high, right? To then fuel the move to the downside, okay? So we know that potentially an institution came in and they wanted to sell, but they wanted to use the buy side liquidity behind this high here to enter the market. So now we have, like we had over here, okay, we had a zone that broke structure. Again, we had that same thing, but it also swept liquidity within the creation of the zone. So it's another little tick in the box that potentially this is a, you know, an institutional zone, okay? Now, what we're going to be looking with inducement is kind of another simple way, I guess I try and think about to teach this, is a sweep zone is kind of like in the past where we're looking at this zone, but it used the liquidity in the past for the institutions to enter the market, let's say, right? The big guy used the liquidity behind here to enter, okay? So that's a good sign that potentially this is a good POI we're interested in. But now the other thing we know is, let's imagine, you know, they want to get short again or add more volume in here to get short. They're likely still going to need liquidity, buy-side liquidity to sell against, right? So what you want to see is you want to see that inducement build in front of the POI again, right? So that when price comes in, there's that buy-side liquidity that then they can sell against, okay? And there's basically two areas in which that can happen. It can either happen, if I draw this again, or I'll just do it here for the sake of time, right? It can either be built here, okay, where you'd have a bit of a pullback like that, right? And then you've got what? We know there'll be available liquidity behind that high, or it can be built in the pullback, right? Where you can get that buy-side liquidity here, then price comes in, and then they've got all of this liquidity to sell against. Okay, so there's two areas. It will either be already available in the previous leg to the left, or it'll be built in the right, or we get both ideally. Okay, and that's what we're trying to do essentially now. We'll add in that another thing to help increase the probability that this POI may hold. So before we hop on the charts and kind of look at some real price action, kind of want to just go over one last example, because obviously we can have nice simple chart annotations on the whiteboard, but when you look at market price action, it can look a bit more erratic and quote unquote random like this, right? So how do we make sense of it? Well, first thing we always do is look at market structure, okay? And if we kind of just squint your eyes a bit and look at the bigger movement, what can we see? Impulse down, swing pullback there, next impulsive leg to the downside, swing pullback, and next potential impulsive leg to the downside, right? That's the overall skeleton, the framework that we want to build. So let's quickly just draw on some market structure like this, right? And then this would be at this moment our current weak swing low. Okay, so some of you might want to always label this when you're in the market, because it can really help you to just remember where you are. Okay, and then we'd have up here our strong high, right? This is our current level that we expect to hold because it broke the previous low. All right, so now we have our strong high. Okay, so now we're starting to already make a bit more sense of what's going on here, right? We know what swing range we are playing within. Now let's just kind of start back here and build the picture a little bit. Because what do we have? We have a supply zone that led to a breaker structure, right? So we have our higher time frame zone. Let's say it's the 4-hour price action, right? And let's just say we've got this big 4-hour zone up here, okay? But imagine what we're actually looking at here is this is the M15 price action, right? So we'd have if we went on the 4-hour chart, we'd have a nice 4-hour pivot zone here. And now we're on the M15 and we can see a bit more of the detailed price action within here. So if you look at the creation of that zone, what do we see? That price actually was up here, right? We had a high that broke that internal low there. Okay, so we know there'd be a decent amount of liquidity that would now build up behind that high because it broke the low, right? So there'll be people now looking to do what? They'll be looking to short this high here, right? So, we might even be doing that. We'll be looking at the supply that broke the low, buy side liquidity builds up, and then you get stopped out. So that's what we we're just talking about, right? With sweep zones, a sweep of strong structure that then leads to a break. So that's a decent sweep POI, right? That's swept a strong high. Okay, cool. And then we get that break of structure to the downside. Now, if we think about inducement, right? There's just, in this instance, just one straight push. There's no liquidity in the leg, right? You'd want to see something like that. We get a bit of a pullback. Then there would be available buy-side liquidity, but there isn't, okay? So whenever we have that, what I'll typically do is I'll use just an empty box like this, just to signal on my chart, just to remind myself that there's no strong liquidity in the leg there, okay? Now, what you'll kind of see, I'm kind of go loosely through this, and then in the next lesson or two, we'll make this a lot more systematic, okay? But I kind of just want to show you sort of what can typically happen in the market, right? Obviously, we know that not everyone, everyone's trading for different reasons at different levels, looking at different time frames. They're not even trading, they're just transacting commercial volume. There's all sorts of activity going on. So when we get a pullback like this, right, higher high, price maybe comes into demand, fills some orders, right, we continue going up. Now, let's imagine there's people looking at like this 4-hour zone, right? Or even a step before that. Let's just say someone zoomed in on like, the 5-minute chart and they're looking at, okay, price is making higher highs and higher lows. Their 5-minute is bullish. They see this trend line, right? And they want to buy here. Okay, so what are they doing? They're getting long, there's sell side liquidity below the low. And then what ends up happening is they can get smashed, right? So I'm going to try and do my best to sort of draw this as quickly as I can. But essentially you get that available sell side liquidity, right? That then price then targets and takes them out. Then perhaps people get long on price coming into this demand range. Then you've got a breaker structure here, so we've come up into our 4-hour supply zone. Then we get a break of that low, so perhaps that gives us our M15 zone, right? And then maybe this is something we're looking at, right? We pull back up into the high, the 4-hour zone. We want to get short. However, there's no inducement in that leg, right? You see how it's just a straight push. There's no liquidity built in there. So perhaps there's not enough liquidity for the big guys to keep selling from here, but we'll get short, right? So, we do something like that. I say we, but just, people who kind of trade supply and demand, who don't have these deeper understandings of liquidity. And then, okay, nice tagged in. Yep, sweet, happy days. Can't wait to make some money, blah, blah, blah. And then boom, get stopped out. What happened there, right? I got liquidated. And then that happened that whole time is there could be people buying this trend line and think, okay, now they're in long, right? They bought on the third touch and they're getting on long at this, and their position's starting to go in their favor. And then we got stopped out. And what we realized afterwards is, now there's just these big equal highs that were built behind us, right? There's all that buy side liquidity that was built, for anyone who's getting short on a double top or the supply zone, whatever way you want to view it. And then all of that liquidity gets taken into, and maybe it's now even more high probability because we've hit a refined M15 zone, right, at the extreme of that leg within there. Okay. But there'll still be people more buying this trend line. So this whole time, what's happening? There's just tons of liquidity building, sell side liquidity building below those lows. Now, perhaps now we've got let's draw it on, right? We've got the breaker structure or chalk or whatever you want to look at, right? And we had our demand here, and now we have the demand reacted, fell to put in a higher high, and now we have our flip. And what also did that flip do? It swept liquidity behind that high, okay? So now you've got pulled back up into the strong high, a mitigation of a very refined M15 zone within the 4-hour zone. We now have a strong liquidation of those big equal highs that also broke structure. We've got a nice overall strong V-shaped momentum to the downside, right? Showing that momentum coming in, that overwhelming imbalance between supply and demand. We have a flip, right? It reacted to demand, fell to put in a higher high. It swept liquidity and moved to the downside. So now we have a flip that swept liquidity, broke structure, right? And then this becomes a much higher probability short position, right? And that's when eventually you can see that move eventually goes, right? So you might take 2 or 3 or 4 losses before the move goes. Now, what would have been even better, which I didn't draw, is there was no inducement in this leg, which some of you may have realized. So what would be even better is if you had something like that, right? And now you've got some inducement for this level here, okay? And that whole time when you're getting short here, what also has happened, you've got to think about all the other market participants trading for whatever reasons, having different views, right? You've got those equal lows there, right? People buying, potentially they see this as demand, they see that as a strong low that broke the high because they don't have a bigger idea of multi-time frame analysis or whatever reason, and then they're getting long in here because they've been stopped out here. Now they think the market's going the other way, right? If they got short here, they see that go. Now they want to buy the higher low to do that, and we've just generated more sell side liquidity below those equal lows. So now we've had liquidity taken, we can get short, and we've got liquidity to target, okay? And then all of the liquidity below there, the internal range liquidity. It's another concept we'll talk about in a future lesson, and that's typically then when you get those impulsive movements. Targeting the liquidity below the weak low there, the external range, okay? So that's a lot more. Obviously, there's so many different variations in which ways that can happen, where just all of that liquidity and all of that sort of madness goes on, right, before you get the real move. And what we're going to be looking to do over the next few lessons is looking at kind of sort of the systematic way in which we're going to try and approach this and the exact things that we're going to look for in each time, okay? Because obviously price action is going to be unique in every single scenario, but we want to look for those specific key patterns to arise, and then we'll always know if this happens, then I do that. If that happens, then I do that. If this happens, then I do that. Rather than, what if? Is it going to take that? Is it going to do this? Is it going to do that? We're not going to worry about what is going to happen. We just know that if this presents, that's the decision I have to make, right? If this thing forms, then I always do this, because you're going to have that framework that you're going to have tested over time. And it's not going to give you 100% strike rate, of course, but you know that if you always just follow those rules, when this happens, I do that, then over the long course, you'll be okay. It's removing that hesitation from the market and trying to make yourself have that profitable edge over the long run, right? And then we'll start to make method of the madness and hopefully not get sucked into those positions where you can end up becoming the liquidity. We want to wait for the liquidation and all the rest of it, and then we'll get involved, okay? So before I ramble on any longer, let's take a bit of a loose look on the charts, and then we'll kind of really dive into the juicy details of those entry models.